Today on my radar is a stock from the oil and gas space. The stock we are watching out for 2023 is the energy major ONGC. Now, three things that define the earnings for this company: crude prices, gas prices and production levels, among other things. So why exactly are we looking at ONGC this year? The outlook on Brent prices is at $90 per barrel for 2023, and China is reopening, which is expected to increase demand and it will push prices as well higher. Kirit Parikh Committee's recommendations on gas pricing are positive for ONGC. The Mozambique project, which may see progress in 2023, and output from Sakhalin-1 is expected to normalize as well. So let's discuss these in greater details. First is oil realizations. Crude prices are expected to be higher and net realization for ONGC may stay above that $75 per barrel mark despite windfall taxes. The question really remains is whether the government will ensure realizations at current levels. So far, the windfall tax levy indicates that yes, it is possible. Stock price implies a $45 to $50 per barrel realization, which is way below current realizations and is positive. At $75 per barrel, average realizations are higher than that between FY15 to FY22. Now on to gas prices. One of the highest levels that we have seen since APM gas pricing has been introduced. In fact, there was a fear that this has been very volatile and there could be some taxes here as well. But now Kirit Parikh Committee has put out some recommendations for gas pricing, which included valuing domestic APM gas prices to 10% of Brent prices, putting a floor to domestic gas prices at $4 per MMBTU, and also proposed 20% premium over prevailing gas prices to incentivize production from age-old nominated fields. This, if approved, will be very positive for ONGC, as company's cost of gas production is $3.50 per MMBTU. Now on to production levels. The Mozambique project, which was delayed, where ONGC has 16% stake, may see further progress in calendar year 2023. And Sakhalin-1 field, where Exxon declared force majeure due to Russian war and where returns come via equity oil for ONGC for its 20% stake, is expected to see normalized production by March 2023 as well. The other thing that works for ONGC is the dividend payout policy. Their dividend payout has been between 30 to 60% in last few years. That definitely is positive for investors. Now, what are the possible risks? Production levels. Oil production from domestic fields is down now to around 19.5 million tons in FY22 from 26.5 in FY 2005. And gas production from domestic fields is down to 20.6 billion cubic meter from 24.7 that we saw in FY19. And ICICI Security remains conservative on production growth estimates as well. Other risks include delay in start of production from KG-D6 basin, decline in oil prices, higher windfall taxes, and no action on Kirit Parikh Committee's recommendations. Stock has valuation support, trades at 2.7 times FY24 EPS and 0.5 times price to book value. And leaving you now with the brokerage recommendations as well, the likes of CLSA, Goldman Sachs, HSBC, they have buy rating, and the ones like Kotak City, they have a sell rating, and other names are also there on the screen for you to see.